The Cheesecake Factory bakery first opened up in 1972, where the Overton family made cheesecakes based on Evelyn Overton's recipes. Her son David Overton opened the first Cheesecake Factory restaurant in 1978 in Beverly Hills, California. Here he was able to place his mother's cheesecakes on the dessert menu. Since 1978, the company has grown and was finally incorporated in 1992. The members in our group are Kathleen Lowe, Han Tian Tran, Annie Wu, Zhao Wei Ni, Emily Wang, and Timothy Yang. The Cheesecake Factory was co-founded by David Overton and his parents. Since the incorporation of the company in 1992, Overton has served as CEO of the company and chairman of its board. Through his extensive efforts, he helped to bring the company to $2.3 billion in revenue in 2017. In doing so, the corporation has become one of the leading companies in the restaurant industry. The company's board of directors contains 7 people, 6 of which are independent members. Along with David Overton, there is also Jerome I. Kransdorf, Alexander L. Capello, David B. Pittaway, Herbert Simon, Lawrence B. Mundell, and Eddie A. Ames. The different types of committees of the board are the audit, compensation, and governance committees. With the exception of Overton, the rest of the board members are all independent. The company has separation of ownership and management. Its managers are David Overton, Chairman and CEO, David M. Gordon, who joined in 1993 and became President in 2013, Matthew E. Clark, Executive Vice President and Chief Financial Officer since 2017, Scarlett May, Executive Vice President, General Counsel, and Secretary since 2018, and Keith T. Carango, who is President of the Cheesecake Factory Bakery Incorporated and who has worked for the Cheesecake Factory since 1996. The Cheesecake Factory seeks to uphold strong corporate governance policies in order to help the company grow and meet shareholder expectations. Management is expected to communicate successfully with the corporation's stakeholders, although the board is not restricted from doing so as well. By communicating with its stakeholders, the corporation can develop new policies to meet the public demand. As mentioned before, all but one of the board members are independent. By having an abundant number of independent members on the board, there is an outsider influence and there is more objection to how the company operates. This is a good thing because more objection can lead to new ideas of growth and expansion. Moreover, because they are independent, they also have experience in different sectors of business. Having Overton as a non-independent member is also good because he knows well how the company operates. In choosing these board members, the company looks towards a balance of capabilities and diversity with age, gender, and experience. Board member terms are not limited because experienced members have considerable influence and because they hold proper understanding of the history of the company. Even so, there are annual self-assessments held to evaluate the committee and their efficiency for purposes of ensuring that all members are doing their jobs properly. Board meetings are held once per quarter to discuss any company issues.
The average investor or the majority of stockholders for the Cheesecake Factory are institutional, owning about 109.61% of the stocks. Currently, investment banks are attracted to the stock. The company has listings in 4 markets such as the Middle East and Europe. There are 21 analysts that cover the Cheesecake Factory and the average recommendation is to hold. The trading volume for the company's stock is 638,856 as of June 11, 2018 at 1:01 p.m. and insiders have been selling their stocks.
Stock prices. On June 1st, 2013, the Cheesecake Factory shares traded at $41.89. By the first week of June 2018, the stock price had grown to $54.06, representing a return of 29.05% over the 5-year period to June 8, 2018. The company's stock price grew to a high of $64.16 in April last year, and this represented a return of 53.16%. Company's equity. Cheesecake's equity is not as risky as most of the stocks trading in the equity market. It has a beta of 0.61, and this means that its stock price tends to trail the market. For instance, when there is a general decline in the value of stocks in the equity market, Cheesecake stocks declines by a smaller margin than most of the other stocks do. Equity and debt. There is low leverage in the capital structure since the total debt is 16.2% of the total capital. The company's total debt is $118.63 million, while the interest expense is $5.8 million, and this implies that the cost of debt is 4.89%. The company has no bonds and therefore it lacks a rating. The weight of equity relative to debt is 83.8, while the debt's weight is 16.2. The cost of equity is 4.01%, while the cost of debt is 4.89%. Company's cost of capital. With the weight and cost of debt, as well as the weight and cost of equity, we can calculate the weighted average cost of capital, which comes out to be 4.14%. Further analysis. The regression analysis in the beta calculation shows that the coefficient of the model is 0.61. The Jensen's alpha for the company, on the other hand, is 1.83%. The volatility, as indicated by the standard deviation, is 1.417, and this is lower than the industry's volatility that is as high as 3.28.
The Cheesecake Factory has had an increasing return on equity in the last 5 years, with the most recent return on equity being 25.66%. When analyzing the company in an investor's point of view, 25.66% is favorable, and having this high ratio indicates that the company is generating profit more and more each year. The Cheesecake Factory also has a favorable return on investment capital, which is 28.2% in 2017. This is favorable because it exceeds the weighted average cost of capital, which we calculated earlier as 4.14%. A higher return on invested capital indicates that the company outperforms its risks. Of course, having a higher return on invested capital can make it a little more difficult for managers to outperform themselves in the following year, which is apparent in the decrease of return on invested capital in the previous year. However, the company has been taking a lot of risks in the past 5 years with its efforts to expand internationally. Having a higher return on invested capital compared to the weighted average cost of capital indicates that the company is generating positive cash flows for its investments. This demonstrates that the Cheesecake Factory creates values by investing in positive NPV projects. Generally, the company has invested in more long-term projects in the past few years. They have made extensive efforts to expand their restaurants internationally. So far, they have acquired 3 licensing agreements in the Middle East, Latin America, and Asia, where they have chosen to develop more restaurants.
Capital structure. The different types of financing the Cheesecake uses are debt and equity. With the debt making up just 5.05% of its capital as at the most recent financing quarter, Cheesecake does not seem to be using debt to its advantage. Cheesecake's debt levels are lower than those of its industry are. In this industry, the average debt-equity ratio is 0.6685, meaning debt makes up 66.85% of the capital. Cheesecake's optimal debt-equity ratio is 66.85%, the average ratio of its industry. The rationale for the optimal debt is that the industry has been profitable at a debt-equity ratio of 0.6685. To get the optimal debt level, the company needs to use long-term debt. The implied debt rating of the firm should reflect the factor that its interest coverage exceeds 20 times, and this means that in the future, the borrowing cost will decline since the likelihood of default is low. Cheesecake's debt ratio is low, and it has sustained an impressive revenue growth in the recent past, and this means that the company is a likely takeover target.
Cheesecake Factory began paying dividends in 2012. Over the 5 years, its dividend yield has gradually increased and ranged from 1.08% to 2.2%. The Cheesecake Factory's dividend per share was at 29 cents, which is more than twice it was in 2013 at 14 cents a share. Dividends can be declared at any board meeting and are paid in cash, property, or stock. Before paying dividends, the board can set aside money for other urgent purposes such as equalizing dividends to meet contingencies or repairing property. For instance, Cheesecake Factory has adopted a 10b5-1 plan to help their share repurchase program and to continue returning capital to its shareholders since it allows Goldman Sachs to repurchase the company's shares in the open market. The amount of stock Cheesecake Factory repurchased has decreased over the years due to an increase in share price. Looking at the company's balance sheet, it is clear that they believed it was an excellent investment opportunity because they have a strong cash and marketable securities balance and use some of their excess cash to continue funding their growth of opening new restaurants internationally while still focusing on protecting the interests of its investors. Cheesecake Factory has an average payout ratio of 30.72%, meaning the dividend is sufficiently covered by earnings. It is expected that Cheesecake Factory should be able to pay out 46.31% of its earnings, leading to a dividend yield of 2.56% this quarter. EPS, or earnings per share, should decrease to $2.66, which means the company should be able to continue to pay out dividends. Looking at the analysis, it is too early to consider Cheesecake Factory as a dividend investment since it has only been consistently paying dividends for 5 years. But Cheesecake Factory produces a yield of 2.28%, which is relatively high for its industry and is currently outperforming the casual dining industry, proving it has potential.
In determining Cheesecake's valuation, it is appropriate to use the discounted cash flows, and this means that one needs to use the discounted cash flow, or DCF model. The DCF and relative value approaches yield consistent valuations because they require the examination of the same fundamental value drivers. The firm lags in financing since its debt-equity ratio is below that of its peers. Fixing the financing lag will enhance the firm's ability to undertake projects with a positive net present value and increase its value. The growth pattern of the firm's cash flows shows that, overall, there has been a fluctuation in cash flow over the past 5 financial years. The cash flow increased in 2014, but declined in 2015. It increased in 2016, but declined again in 2017. The key variables to enhancing value are the investment in new projects and the management of costs. To enhance the value of the firm, it is better to maximize the investment in new projects with a positive net present value.
Overall, the company looks like it is doing good financially. It has shown many signs of growth and has become one of the leading companies in the restaurant industry. The Cheesecake Factory has a separation of ownership which allows for diversity in running the company. Over the past few years, the stocks have portrayed the growth of the company based on its increasing numbers. This means that demand has increased and more investors are finding this company to be a favorable investment. With a low beta, the company's stocks tends to decrease in value less than other stocks. An increasing return on equity and return on invested capital indicates that the company tends to outperform itself and takes on more positive NPV projects. The Cheesecake Factory also has a low debt-to-equity ratio, which can be unfavorable because the company does not seem to be using its increased profits to its advantage, but is also a good sign because it shows the company's consideration and protection for its investors. Its high payout ratio also shows this consideration as it is higher than that of the restaurant industry. This means that the company is generous in sharing their earnings with stockholders. Overall, the company looks like it is doing good financially. It has shown many signs of growth and has become one of the leading companies in the restaurant industry. The Cheesecake Factory has a separation of ownership which allows for diversity in running the company. Over the past few years, the stocks have portrayed the growth of the company based on its increasing numbers. This means that demand has increased and more investors are finding this company to be a favorable investment. With a low beta, the company's stocks tends to decrease in value less than other stocks. An increasing return on equity and return on invested capital indicates that the company tends to outperform itself and takes on more positive NPV projects.